The Federal Reserve releases a dot plot every quarter that has the projections of where each Fed member sees the future federal funds rate. The dots indicate each member's prediction. The information is in Figure 2 of the economic projection materials, which also has the Fed's inflation predictions. Those reports can be found at the Federal Reserve website. Just click the tab Monetary Policy and then Meetings, Calendars, Statements, and Minutes. The last dot plot was released in December 2023. A majority of Fed members forecasted then that the federal funds rate, currently at 5.25% to 5.5%, would be cut by 75 basis points by year-end 2024. The median projection at that time was at 4.6%, which was down from a 5.1% prediction in the September 2023 dot plot. The Fed will release its updated dot plot next week. Based on recent inflation reports that are showing sticky core inflation, my best guess is that the Fed will forecast no more than a 0.5% reduction in the FF rate this year, down from 0.75 in the prior dot plot. I no longer view a cut at the June meeting as probable. For there to be a 25 basis point cut on or before the July meeting, core PCE inflation will need to trend down in the upcoming reports, in my opinion. The CME FedWatch tool currently has the probability at 58.8% of a 25 basis point cut on or before the June meeting. The probability of at least a 25 basis point cut on or before the July meeting is currently at 77.6%. In December of last year, the CME FedWatch tool had a 75% chance of at least one cut by March of 2024. Last month's auction of the 6-month Treasury bill was priced at a 5.308% investment rate. I discussed buying 5 in my last post. I will be buying 5 at tomorrow's auction. A 5.308% is close to the midpoint of the current federal funds range of 5.25 to 5.5%. The buyers of that note are signaling, in my opinion, that they anticipate no cut on or before the June meeting and only a slight probability of a cut at the July meeting. The Fed does not meet in August. The 6-month bill bought at tomorrow's auction will mature on September 19th. I'm starting to buy more 2025 corporate bond maturities with proceeds from maturing bonds. So far, I have purchased $9,000 in principal amount of 2025 maturities that I will be discussing in my next post. Possibly more purchases will occur before I publish that post. The largest purchase was 4 Fortune Brands 4% senior unsecured bonds maturing on 6/15/2025. I have increased my purchase to 2 of the 1-year Treasury bills that will be auctioned on Tuesday of next week. That is up from 1 in my prior comment. If short-term interest rates do decline this year in response to Fed rate cuts, then my interest income in 2025 will be lower than this year. So it makes sense, assuming that scenario does happen, to start shifting some taxable income from this year into 2025. That is done with a one-year Treasury bill purchased at Tuesday's auction and held to maturity. The interest income is recognized in the year that a Treasury bill matures, assuming it is not sold prior to maturity. I've never sold a Treasury bill prior to maturity. Purchases of the 6-month Treasury bill starting in July will have the same income shifting effect into 2025. I want interest rates to go up. I have no debt. Most of my total portfolio is in money market funds, Treasury bills, short-term CDs, and short-term corporate bonds maturing within 2 years using a ladder approach where I have multiple maturities each week. I would guess, and I'm not going to bother totaling up the actual number, somewhere between 70 to 75% of my portfolio is in those kinds of securities, with the remaining in individual common and preferred stocks, with Canadian Reset equity preferred stocks being by far my largest preferred stock allocation, Tennessee municipal bonds, which is a significant allocation for me, and stock funds consisting of mutual funds, ETFs, and CTFs. I think that the Fed would do more harm if they cut the rate by 25 basis points in June, and then the inflation reports require them soon thereafter, or in several months thereafter, raise the federal funds rate by 25 basis points. With the economy still being relatively strong, I don't see any reason to cut even 25 basis points until the core CPI inflation numbers are showing a definite downtrend, much closer to the Fed's 2% target for PCE core inflation.